Yo, what's going on, guys? My name's Hayden Crabtree. Today I'm going to teach you how to determine the true value of a property, and there are three different ways to do this. I like to focus on one, and I'm going to explain to you which one that is. But I want you to know all three ways to determine how a property is valued. Okay, so you'll see this in appraisals, you'll see this in different ways of people and how they approach investing. But we're going to talk about the three different ways, and we'll just dive right into it. Okay, the number one way is the comparable sale, which is comp approach. So in this method, what we're essentially going to do, let's say we have a 3-bed, 2-bath house that's 1,200 square foot in XYZ neighborhood. Okay, so if we have this house in XYZ neighborhood, what we're going to do is we're going to go and we're going to look at essentially three comparable sales. So three other houses. So what we want to do is we're going to go look at three other houses, hopefully that are 3-bedroom, 2 baths with 1,200 square feet. Okay, so if we go and we look in one of these houses, let's say one house sold for $100,000, another house sold for $110,000, and the third house sold for $90,000. What that's going to do is we're going to average these three houses and say, okay, the comparable sales approach says that this house of ours is worth around $100,000. Okay, so that's a very rough example. For instance, this house may have 1,400 square feet, and this house may have, 3-bedroom, 1.5 baths. So what we have to do is we have to figure out in properties that are comparable and that have already sold, actually transacted, not for sale, but have actually sold, how can we derive from those what this property would be worth? Okay, so that's number one, comparable sales approach. I don't like to use that at all because, well, here's the thing about that, is that we are relying on negotiating skills of those other parties. So I don't like to use that. What I do like to use is number two, called the income approach. And this is how investors should be valuing property. Okay, so the income approach is very, very simple. What we want to do is we want to look at how much income we get from a property, from the rents, most likely. There are other ways to make money. Well, let's say we get our income, then we want to subtract the expenses associated with that property. And this, whenever we subtract our expenses from our income, it's going to give us our net operating income. This is a very technical term. What you're going to find in the real world is that this is often abbreviated as NOI. So that's really what you need to be familiar with. So the NOI here is income minus expenses equals our NOI. Okay, this is how much the property is making before debt. So if we bought the property with no debt, this is how much would go into our pocket as cash flow. If we did have debt, then debt would come after it. I get all into why you don't use cash flow after debt to value a property in my book, Skip the Flip, which you can get for free below. But you just need to know that net operating income is the basis in which the income approach method is used. So what we do is we divide this by a cap rate, and that's going to give us our property value. If you want to learn more about cap rates, why they're calculated, how they're used, all of that good stuff, it's in my book. I forget what chapter it is. It's about midway through my book, but I deep dive into the NOI and the cap rate and the property value. So for the purpose of this video, we're just going to touch all the different three methods of how a property is valued. This is number two. It's extremely important. It's how I use it, and if you're an investor, it's how you should use it too. You should not be valuing properties based off of comparable sales. You should be looking at how much property and income, how much income does that property produce? Okay, so very important, income approach, NOI. The third method, which is a good method, but it's not the best method, is called the cost approach. Essentially, what the cost approach does is says, how much does this property cost to build? So if I'm going out and building a house and the house cost, with the land, the house cost, call it $80,000, and let's just say it was the same exact house from the first example, a 3-bed, 2-bath with 1,200 square feet. So while the comparable sale approach said that this house is worth $100,000 and that's what others are trading for, maybe we can build that house for $80,000. So that's one way of looking at it. It's maybe not the best way, because if we valued it on cost approach at $80,000, but other people were willing to look at it at $100,000, then we're kind of cutting ourselves off at the knees and not giving ourselves the full value. So for those reasons, I don't like to rely on other people's transaction dictating what my property's worth, and I don't like to look at left behind profit between what it costs to build something and what it can sell for on the market. I like to look at income approach, and I think you should too. If you like this video, subscribe to the channel. Come visit me on Facebook at haydencrabtree.com/community and grab a free copy of my book. Have an awesome day. Crush it.